Yeah. So the bad experience that I had was just not getting good communication from the syndicator. The other syndicators that were giving me good communication, either one group once a month, I was getting some communication, the other group once every quarter, but getting really good communication. And the other guy, his group, we just didn't really hear from him. And I wanted to know what was going on with the property. He ended up selling, getting forced to sell for some reason by pref equity partner, which is a little bit higher on the stack and gets a little bit more say so.
Mhm.
And they got forced to sell for some reasons. I think he kind of fudged maybe on how much equity he had in the deal of his own skin in the game. And you just kind of learn that lesson. I mean, I still made some money, but I'm not going to do any more deals with him.
You're listening to the Gorilla State Investing Podcast. We're not here to bruise your bananas with guru sales pitches, overrated fluff, or any other kind of monkey business. We simply provide the ground-pounding truth about what it takes to be successful in real estate.
All right, today's guest is Trent Bussey out of New Orleans, Louisiana. Trent got his start. He went to LSU, Louisiana State University, and got his bachelor's degree, followed on to get his MBA at the University of Louisiana, Lafayette, before he joined the Navy to become a naval officer. After a quick career there, he got out, got his W-2 job, which he still has today, and eventually started investing in real estate on the side like all of us do. Trent started out with fix and flips, doing some new developments, and eventually, after taxes killed him, joined came over to the light and joined multifamily. Currently owns a fourplex, eventually got into some syndications on the LP side, and now has jumped up to the GP side, where he just closed his first deal as a general partner on 123 units in Houma, Louisiana. Trent, welcome to the show, brother. Happy to have you.
Yeah. Thanks for having me.
Yeah, man. So let's talk about you got out of the Navy, got your W-2 job because you were a lieutenant commander in the Navy, right? And that's where you met your wife. You guys moved back down to the New Orleans area. What made you start investing in real estate?
Well, W-2 job, doing good, making some good money. We have a large family, and the numbers just just didn't add up.
Yeah.
To be able to retire, it's different, I think, than when our parents or maybe grandparents are coming up and they can get on with a big corporation, work 30 years, get a defined benefit plan, and the dollar was probably a lot stronger back then. The dollars doesn't go that far now, so just looking for other ways to bring in money, and trying to build my own dreams instead of building other people's dreams.
I'm guessing your parents did a lot like my parents, go to school, get good grades, get a good job, save. And it sounds like somewhere along the way, did you by chance read Rich Dad, Poor Dad like the rest of us?
I did. I read Rich Dad, Poor Dad actually early on.
Yeah.
And then put it down. I read it. I must have been in college. I was like, oh yeah, that's good and all, but I'm getting my MBA. I'm set, right?
That's how it works. Yeah. Yeah.
And then got out the Navy, and I was working in corporate world, and then it's like, oh, let me pick this up again and see what's going on with this Rich Dad, Poor Dad. So yeah. Love that book. It's a great starter book.
It is. That's kind of like the gateway into the way of looking at money. So you obviously got into real estate and started with fix and flips, right? And that's kind of like the gateway drug to real estate, I would say, is fix and flips or single family. Most people tend to go that route. How many flips did you do? And then kind of like what made you go into multifamily?
I didn't do too many. I think I did 6 to 8 flips.
Yeah.
And it was good pops of money. But as soon as I had to pay those taxes, I was like, there's got to be a better way, right? So I started looking for the next, what's the next way to go, right? And, once I got past the limited belief of having to have your own money, right?
Yeah.
Which is, a big limiting belief I think a lot of people have, So once I got past that, then
how'd you get past that? Because I know a lot of people that just uncomfortable asking people for money.
Right. Well, I actually raised money first from my family, which a lot of people would want to raise money from their family last, right?
Yeah.
But it really makes you hone in and make sure the deal is really going to work, because you don't want to go to Thanksgiving dinner, and Uncle Bob's like, yeah, where's that 50K, Trent, on that flip you did? Right.
Pass the potatoes.
Right, right, right. So yeah, I started, and I mean, I'm not a really great money raiser yet. I'm more on the deal side, finding the deal. Of course, we can all work on raising money, but I just ended up just partnering with people that could raise the money, especially on the multifamily side when you're trying to raise 1.7 million dollars. Unless you have a big investor pool, it's going to be tough to do without teaming up with some other people.
Absolutely, man. Well, when you were doing those flips, were you doing all the work yourself?
No, no, I did a different model. So, like I said, I have a big family. So I wasn't looking to, swing the hammer. So what I did was I would find a deal, and then I would underwrite the deal in the way that I can hire a contractor to do all the work. Now you got to trust the contractor, right? So, I went through a couple contractors, but really found a guy that, we meshed really well, and he would do firm fixed price. So he would say, hey, this house, Trent, I'm going to build it for 205,000. And if I go anything over, then I'm going to eat that out of my profit, because we were splitting 50-50 on the back end. So he
Yeah.
would cut his profit off on the front end. And then, like a regular contractor, he wouldn't charge like the regular amount. So he would take his profit off because he made more partnering with me and splitting 50-50 on the
Okay, that
back end
makes sense.
when we
If he
sold it.
came in short, would he coop that or no?
If he came in short,
Like
meaning
if
if
he
he
did
went
it for
over
ten
budget or
thousand,
went
no,
under budget.
if he did it for $10,000 cheaper, was that money his?
Yeah, because the way I look at it is the way I like to underwrite. I want as many fixed costs as possible.
Okay.
So it's like,
Okay.
hey man, if you say 205 and then you do it for cheaper, you don't even have to tell me. We got our deal 50-50 on the back end.
Yeah.
But if you go over, I don't want to hear from you then either. Right.
Yeah, yeah. No, I like that. I've never done a fix and flip, and that's interesting to me. I didn't know that you could do a fixed price like that. So that's awesome.
Well, I mean, on the new builds, the numbers are tight, right?
Yeah.
Those are easy for the contractor. They're taking on a little bit more risk when it's a fix and flip, because they start opening walls and different things. But we were buying Katrina houses to where we knew, I mean, they were pretty much gutted anyway.
So Katrina happened in 2005, so I'm guessing the timeline works out for you there. Did that open up quite a few opportunities for you after the hurricane in your area?
Wow, I mean, I wish I was around here and doing real estate. I was still in the Navy until 2011.
Okay.
So, I mean, people were scooping up houses in affluent areas for pennies on the dollar after Katrina, and they probably made a buttload. But I mean, we still did pretty good on our flips though.
Yeah, it's an interesting thing to me how because like we both grew up in Louisiana, and I actually own in Panama City. I own in Louisiana, and as horrible as hurricanes are to the area, they bring a lot of opportunity in the couple of years to follow. In fact, there's people called storm chasers who just literally chase hurricanes, natural disasters because the real estate market booms for a couple of years following that. Um, and I think with New Orleans, it was like more like 5 or 6 years following that.
Wow,
So
I think even more. They're still. I mean, they're still rebuilding. The population's still not back where it was.
Jesus.
So
Okay.
I mean, there's still opportunity.
All right. So you realize that to come over to the light into multifamily. What'd you start out with? How'd you find your deal, and then where'd you go from there?
Uh, e- well, as far as the multifamily side, we bought a fourplex, did that. It cash flows a little bit, but it's a lot of work. I look at it as a lot of work because you're getting called at night if the toilet, something happens, a dishwasher, if they leave food in the bottom of the dishwasher, you got to go over
Yeah.
there for that. But, the way I found my deal, the large deal is through a broker, and really just building that relationship with the broker. And what he told me is, he said, Trent, I started really giving you the real off market, because there's a couple different levels of off market deals, right?
Yeah.
But when I bought this 123 unit in Homa, I was probably either the only one, or I'd like to think I was the only, or maybe one of three people that even looked at it. But he started giving it to me because he said, hey, look, anything I would send you, you would at least give me feedback and underwrite the deal, because he's like, so many people, you send them off markets, you just never hear from them. So, after a while, he really started giving me, shots at some really good deals. So
How long did it take to build that trust with that broker?
I don't want to scare anybody off. It really took 4 years.
Yeah. Did you decide to start syndicating like 4 years before you got your first deal closed on the GP side?
No, I talked to the broker over the years, but I mean, I didn't really get serious until after I did some LP investing. So maybe it was a year and a half where I was really, bringing him to lunch a lot, talking to him, and he was starting to send me more deals. But I've been knowing him 4 years.
Okay, cool. So you essentially went into multifamily, where you bought it with your own money, right? The 4 unit, managing it yourself, and then decided, okay, I want to get into multifamily, don't want to do as much work. So you went passive on the LP side, the limited partnership side, and you did that 3 times, right? Over 1,000 units as a limited partner. What was your experience with those syndicators? And then what made you decide you want to do your own syndications?
I had 2 good experiences and 1 bad experience
Okay.
with the syndicators. So what I learned, the best thing that I've learned being an LP, is you really learn how to underwrite correctly, right?
Okay.
And then you're on a lot of webinars. Syndicators are sending you deals, so you get to see how they're structuring deals, what returns they're promising, and then you start to kind of figure out, hey, once you're able to underwrite better, which you get a lot better at underwriting doing LP investments, you get to kind of not call bullshit or BS. Sorry, pardon my French.
It's fine.
But if they're really where syndicators get in trouble, I find, is on the revenue side. The expenses are easy to figure out. I mean, your insurance is going to go up, your tax is probably going to go up, but everything else, the expenses, you're looking to reduce those, and those are easy. It's the revenue side where people try to increase the revenue or be more unrealistic on what kind of rent they can get for a renovated unit.
Yeah.
Right. And so, because a lot of times I find they were relying just on the rent growth of the market for the return. And that's, for me, that's too aggressive for me as an LP investor. I want some forced appreciation.
Yeah.
A little bit more than putting a backsplash.
Yeah. Yeah.
So,
I hear you.
like the broker, you talk to the broker and he says, hey, Trent, man, you can get $200 rent bump if you put a new backsplash on this. I'm like, no, man, I'm not doing that.
Yeah, no, you can't. No, you can't. Takes a little bit more.
Right.
Yeah.
But yeah, I'm just joking. But yeah, so the bad experience that I had was just not getting good communication from the syndicator. The other syndicators, they were giving me good communication. Either one group once a month, I was getting some communication, the other group once every quarter, but getting really good communication. And the other guy, his group, we just didn't really hear from him. And I wanted to know what was going on with the property. He ended up getting forced to sell for some reason by pref equity partner, which is a little bit higher on the stack and gets a little bit more say so.
Mm.
And they got forced to sell for some reasons. I think he kind of fudged maybe on how much equity he had in the deal of his own skin in the game. And you just kind of learn that lesson. I mean, I still made some money, but I'm not going to do any more deals with him.
Yeah, that makes sense. And I know exactly what you're talking about with budget, because all at the end of the day, one of those pitch decks is just somebody manually putting numbers into something. And I've seen it happen where you could sit there, watch somebody underwrite, and they say, okay, well, let's see what we can do here. And that makes the number work. Okay, that doesn't make the number work. And just moving numbers around. But at the end of the day, if the numbers that you're moving around aren't realistic, then all you're doing is selling a lie. And I could see how it happened. And what would be some red flags from you if you are telling somebody, hey, who wants to be a limited partner? What red flags from the general partnership would you tell them to look out for?
Right. So when you're looking at a deal from a group, and the deal is kind of small, maybe $5 million or less, but there's a high acquisition fee percentage and there's a high asset management fee percentage, that means that they don't really believe in the deal and the deal's too thin. Because think about it,
Define high for them.
3% asset management fee, I think is high on a small deal, because when you start to underwrite and you see, well, like they're just making sure that they get paid, and they're putting that percentage up to where the GP can get paid, because hey, they're in the business of making money, right? So we don't
Yeah.
do this for free. I mean, we love real estate, but hey, we're trying to build, some legacy wealth ourselves. But if they have to put that percentage up that high to where they are definitely getting paid, because that asset management fee, they're getting paid before the investor, before that pref equity.
Yeah. What
So
about acquisition fee? What would you say would be a high acquisition fee?
it just depends. I look at how much money it is. The percentage doesn't really, I mean, they're doing work. I mean, I just been through one, right? And I did the physical due diligence, the financial due diligence. There's some work to get it to the finish line.
Yeah.
But if they're like, if it's a large deal and they're trying to get $500,000-600,000
Yeah.
for an acquisition fee, because if they do it by percentage, they're like, oh, well, it's industry standard and it's 50 million. Look, underwriting, I mean, doing due diligence on a $50 million property and a $25 million property is not that different.
Yeah.
There's more units to walk, but you're usually having your property management company come in and walk the units, with you anyway.
Yeah. I can agree to that. I would say the acquisition percentage would be a little higher on smaller deals and lower on larger deals, but the asset management fee, I agree with you. Like it, and it depends on, to me, it depends on what the projection, what the business plan. If it's a heavy lift, there's a lot of moving parts in there, then I can agree to pay a higher asset management fee. But if it's a turnkey property and that's what you're buying into with lower returns, well, then don't lower the returns for the investors by increasing your asset management fee.
Right.
And for the people who are listening and who have never done a syndication, acquisition fee is just that. The general partnership team is going to charge a percentage, just like a real estate broker would, for brokering the deal up front, putting it all together. And they deserve that, because without them doing that, there would be no opportunity to invest in. You just got to make sure, like if your real estate broker told you they were going to charge you 10% to sell your house, well, you'd probably say, I don't care how good you are, I'm not doing that. Right. So
Right.
you got to make sure that the industry standard for acquisition fee, I think, typically caps out around 2%. You see 1 to 1.5 on larger deals, 2% on the smaller deals. But if somebody's doing 3%, then it had better be a dang good deal, like something that only they could get because of their access to off-market deals. But
Right.
yeah, so anyway, so you decided to do the LPs. Did 2 LPs that you liked, one that you didn't like? What other red flags would you say are out there?
I mean, mainly, really, for me, it was communication, right? So I want to be communicated with as an investor. Uh, not on the phone or anything. Just send us what's going on. That definitely tell us the problems you're running into. Is even better than telling us the wins, right?
Yeah, yeah,
At least you're being on. But that's the main thing. Main thing is when you learn how to underwrite really well by looking at a lot of these deals, just looking at those percentages, being able to say, hey, it's a little bit too thin, meaning they're just getting, or if you're getting you're getting paid mostly on the sale,
Yeah.
right? So say like, oh, well, IRR or, your annual rate's going to end up being, 20% a year, but it's on the sale,
Yeah.
right? 7 years, 7 years from now, we don't know what the cap rates are going to be. We know we know they're compressed right now. Now they may creep up a little bit, but that long, I want to get paid more on the cash flow. So
Yeah.
that's why I like the bigger value add deals, especially for the LPs, because you know that you can pay them off of the cash flow,
Yeah.
right? And not relying on that sale, because if you're tying their money up for 3, 5, 7 years, you know, I like to give them a lot of that meat on the cash flow.
Yeah. And then banking it on market appreciation 5 to 7 years from now, you know, that's just
Uh,
like what's the old saying? Buying for cash flow and equity happens, right? I mean, that's
right.
it doesn't change at multifamily. If you buy because it cash flows, you can't go wrong. Because even if the market goes down, you can hold on to it; it'll still cash flow. But if you're banking on that sale happening at the end and it appreciating, 20%, if that doesn't happen and you didn't cash flow, you just tied your money up for 5 years for really not much.
Right.
So and that's for me the things to look out. And this is recently because I've been looking at co-GPing with other deal sponsors. So it's not much different than looking at it from an LP standpoint. If they put the deal together, they're bringing you in on that deal package to help them get it to the finish line. One of my biggest red flags, if there's a lot of maybes or possibilities or we could or we woulds before closing, I'm out, right? I need it to be, this is the plan. This is what we are doing, not we could do this, we would do that, or, it's possible we could do something to the laundry facility. No, no, no. Once the money is wired, the plan is in place. Now, I can 100% agree with leaving room left and right to deviate from a plan in the event something outside of the plan happens, a contingency perhaps. But I'm in the military. You were in the military. We plan for contingencies, and if I don't see that translate into the real estate world, then you haven't thought about what the stress test. You haven't considered what could go wrong and what you're going to do quickly in the event it goes wrong. And I'm not one for what ifing something to death. We do that a lot in the military. What if, what if, what if? But you need to what if at least a couple layers back, in my opinion. If you don't see that in the plan, and when you ask questions, you don't get those answers, to me, that's a big red flag. What do you think about that?
Right. Well, I don't know about you, but I'm seeing a lot of people closing deals out there, and I'm wondering how some of these deals are working,
Yeah.
right?
Yeah.
So I would rather, close on the ones that are going to work, definitely going to work, than close three in a year that are so thin. You're hanging your investors out there, risk, for your investors and for you and for your reputation, right? So
Yeah.
yeah, I definitely agree with that.
All right. So let's talk about the most latest acquisition. You have 123 units in Houma, Louisiana. Your first general partnership, or your first time on the general partnership side. So you've seen it 3 times as a limited partner. I'm guessing that created some interest there for you to be on the general partnership side. And earlier you had talked about not wanting to swing the hammer, not wanting to do a ton of the work. And how's that worked out with you? I know you're not swinging the hammer, but how much work have you had to put in since you decided to get started? Kind of tell me that timeline to now you finally just closed your first deal.
Wow. It's still a lot of work, but when you love what you're doing, or when you're passionate about it. So most of the work up front was, during I got a W-2, so during lunch I'm talking to brokers. In the evenings, on the weekends, I'm underwriting, right?
Yeah.
Talking to brokers and underwriting, talking to brokers, underwriting. And what I was trying to do, which was kind of a mistake, which hindered me really because, 4 years, right? Or I'm
Yeah.
saying 4 years. I'm really serious, maybe a year and a half to get it done. But I was trying to find deals and raise the money.
Yeah.
So, kind of chasing two cats where I'm thinking maybe it should have been either or, right? So I was
Yeah.
trying to funnel, come from healthcare. So talking to doctors, bringing them the lunch and doing that. And then in between, I'm talking to brokers, bringing them the lunch, underwriting at night, those types of things. So where it really, the catalyst that really made me pivot, or really, I think catapulted me to really get a deal, was when I decided who, not how. Not how do I raise the money, who can
Yeah.
I partner with that can raise the money, and I don't have to worry about that side, and I can strictly look for deals, underwrite deals, and maximize that to where I can get to that first deal.
And so how did you end up finding a good partner?
Paying for proximity. So, I mean, going to conferences and going to master classes, and I'll plug my guy right here because he has a great class. But Tim Brott's Commercial Empire is where I went in October of 2018, and that's where I met some guys there, and through that kind of family is where I found my partners.
You just said paying for proximity. I've never heard that, but that makes perfect sense, right? Especially essentially getting into the room where the deal makers are at.
Right.
That's a perfect saying.
I'm going to do a little bit of a, we're both military, we're both Navy guys. So, I mean, when I'm at my in-laws, we're playing golf. My father-in-law and I, he's a retired Master Chief. We're playing golf on North Island on Coronado all the time, and it's
Yeah.
super cheap. But I mean, you're not going to raise money. I mean, you possibly could raise money on that golf course, because they'll pair us up with other people,
Yeah.
because there's a lot of people playing. But that's why some people now I haven't done this, but why not join a country club? I mean,
Yeah.
you're paying for that proximity, but I mean, you might be, if you're in a golf club that costs money, costs a good pretty penny, that's going to be people with money that's playing there.
Yeah.
And not looking to play at the community course or on base or something like that. So.
Yeah, on base. So I tell you what, my original perception of the military network, I was like, man, I don't really care to network a bunch of military people. They're just as broke as I am. But the one thing that I figured out is there's a lot of Facebook groups and stuff with military, ex-military, where people who took the reality that, like getting the mission done, whatever it is, when they get out of the military, and now they basically unleashed into the world of capitalism and investing, and they've been waiting to do it until they could retire or whatnot. Or maybe now they're retired after 20 years and they have a life sustaining check. It might not be a lifestyle sustaining check, but it is a life sustaining check. And they can, they've been waiting 20 years to get out and do it, and now they're doing it.
Right.
My military network has actually helped me close my first deal, because the majority of the people just got money sitting around and they haven't been able to employ it because it's just been stacking up. And so I've kind of shifted my mind, but it's not, you're not going to meet somebody in the military who's got a couple mil to drop. You know what I mean? It might be
right
50, 100,000, maybe if they're out in California and the housing market went up or something, but you're not going to meet a dude who can solve all your problems in one fell swoop in the military,
right.
for sure.
And with raising money, what I've been told, and I forgot who told me this, but raising 50,000 from someone and raising 250,000 from somebody is totally different. They're totally two different type of investors. So whoever's going to stroke a check for $250,000, you're never going to hear from them.
Really?
Because they're going to be more of a sophisticated type investor.
Yeah.
They're probably deploying a lot of money if they're deploying $250K into one deal.
Yeah.
But $50,000 for someone to get, they might want to know what's going on with the property a lot more, because that's probably a lot of money to them. Right.
Yeah. So you're saying that the $250,000 check writer, once the check's written, they kind of know what's going on. They're not going to bug you about it. But $50,000, that's probably somebody's like life savings right there. And hey, man.
Right. Well, I mean, it's a lot more investors for investor relations. I mean, if you're raising 50 a pop and you're 1.7 say or $2 million, I mean, that's 40 people.
Yeah, 100%. Well, so was your 123 unit, was that a 506B or 506C?
We did a 506C on that one, actually.
Okay. Okay. So did you, by the time you said you pretty much split chasing two tails, right? And you focused on the deals. You partnered with your capital raiser, or not your capital raiser, your general partner who had the ability to raise more capital. Was that what made it where you guys could do a 506C? Because he had more accredited investors in his network?
Right. So yeah. So I mean, it's a group. It's two guys, and they're kind of built out, and they have some asset managers and some, but they do 506C. I mean, they raised all the money, most of the money they raised in a weekend.
Jesus, man.
Right.
Yeah. That's awesome.
So yeah,
well, that helps solve your problem, right? So now you can focus on what you've been focusing on, which is underwriting deals. And you've said it probably 5 times. You learn how to underwrite. And that's a skill set that I know a lot of the bigger guys that, they know how to see what wrong looks like on an underwriting spreadsheet, but they don't want to have to go through the work to to vet every single deal. So it sounds like that you solved a problem with them, which is deal flow and having a package where they can quickly say yes, and they solved the problem for you, which is raising capital, and now you guys have a good relationship in that matter. And I think that is very important. It's in fact that's a mindset that most syndicators, I believe, go through, self included, when they get started. Is they think that they're going to be the sponsor, they're going to be the KP, or probably didn't even realize you have to have a sponsor when you got started, right? Like, what's a KP, right? Like, wait, I have to have net worth the same amount as the loan.
right.
This deal just got real small, right?
Going back to the fourplexes, right?
Yeah, that's right. And what I've noticed is it's typically 6 to 8 months, but from the time you get started and all right, I'm serious, I want to syndicate something, until you realize I can't do this alone and I need to start looking for other people. And it's about a year until people actually close on a deal. Once you get serious, if you're dipping your toe into, I think I want to syndicate, like you said, 4 years of being interested, but 1 year of, all right, I'm doing this. And it's not a quick process, right? So tell me, walk me through, what you said. You made the mistake of thinking of chasing two tails. Then you met these guys and they solved that problem. Is this your team now, or are they completely separate and they'll partner with you if the deal is right? Are you still out there on your own trying to do all this stuff, or do you have other people that are part of your team?
Well, I'm still on my own, and so I think my next step is finding someone else to complement me on my full-time team. Partnering up with someone else, maybe that can raise a little, can raise some money, because I'm not focusing on that part. I mean, I can do the operations, the asset management, those things, underwriting a deal, and find a deal. But that's pretty much the next step for me would be finding a partner to be on my team, because the guys that I did, they'll partner with me again. But they said, hey man, let's do one more deal together or more. And then after that, Trent, man, you need to be doing your own deals, and which is good, and it's like, hey, if you get into a problem to where it's, $50 million and you got a team and it's a little bit too much for you to close, then hey, look, we'll partner again. We'll get our groups together and partner again. But so I'm still kind of, solopreneur. I have a virtual assistant that's helping me with some being more consistent on the marketing side, a little bit branding and, staying on social media. But I'm looking for other ways to get out of my own way, I would say, because I'm the choke point, right? So
Yeah.
even with underwriting, if I'm doing the revenue generating activities only, which is talking to sellers, talking to brokers, and even talking to investors, even though
Yeah.
I'm not focusing on raising money, then choke point is underwriting. Now I can
Yeah.
underwrite a deal, but how can I underwrite 10 deals
Yeah.
instead of 2 deals? So I'm looking at possibly filming myself underwriting and then, possibly maybe hiring some virtual assistants to do some of that initial, put a lot of the numbers in, then I can fine tune it.
Are you trying to work yourself out of your W-2 job?
Of course.
Yeah.
I am. I'd love to do real estate full time because it's not work to me. I mean, I really enjoy it.
How far, like, have you set up your a goal for like a timeline for that, and are you on track to do so?
Timeline, I mean, I haven't reversed engineered with, exactly like when I would be able to do it. I probably should, right? But a lot of people say throw around that 10,000 a month, type, to get out of their W-2. And I'm right around there too. That's kind of what I need, to get out of W-2. So I need probably 2 more deals depending on how much meat's on the bone.
Yeah, I hear a lot of people say, you don't want to get into syndications with people that are part-time syndicators. And while there's some truth to that, there's another side of the coin that I look at and I says, well, I don't know if that's necessarily true, because part-time syndicators have a W-2 job. So they're not desperate to get a deal done. Whereas full-time syndicators, if there's no deal getting done, there's no money being made. So just kind of think in your head, who do you want to deal with? Somebody who has to get a deal done regardless of the underwriting, regardless of the market, regardless of the process, or somebody who has the ability to not do a deal and still be fine. To me, and I don't want to say that full-time syndicators are desperate, but there is definitely the potential there for them to get desperate in the event that things start to go south. And those are likely the people you're going to see who need the higher acquisition fees, who need the higher asset manager fees, because that's their only source of income. So they got to have that cash flow for themselves as well. So I kind of call bullshit on you can't do it part time. I think you do need to have a good team. You need to have somebody who's very experienced. But me and my team, everybody on our team has some sort of other job carrying us through, which allows us to be a lot more patient, allows us to only pounce on deals that makes absolute sense for our investors. And so that's my perspective on it. And I don't think you need to be full time to do it. But obviously, everybody who's doing it wants to go full time. Well, we wouldn't be doing this if we didn't love doing it, right? So,
Right.
yeah,
Yeah, because we're doing it, I'm doing it late at night or if I can get up early in the morning. I'm more of a night person.
yeah,
But I think the part-timers that are trying to get out, like I can really speak for myself, we're hungry too, and we're
yeah,
willing, having that work ethic to be able to stay up at night or earlier in the morning and maybe sacrifice some other things that people would be doing maybe on the weekend or is that says a lot too.
So, what's your vision? Like, what are you chasing with all this? What's at the end of the life of this?
Chasing cash flow, man.
Yeah, but why? Like, what's the ultimate goal? What you gonna do with that cash flow?
I mean, my family and I, we want to travel a lot. My wife's family's from the Philippines. We want to go out there. I want to be able to go somewhere for a month at a time. I don't want to have to ask permission to go anywhere.
Yeah,
From somebody. And that's more of a short term goal is being able to travel and do things, and then maybe later on. I mean, impact the world in some kind of way, uh something for good, right?
yeah.
Maybe giving back to the military or uh something like that. But in the short term, yeah, I'm trying to be able to travel more with my family, I mean, I have a 17-year-old, she's about college. So, to be able to travel where she's at. And, there's only so much leave you have when you're working for someone.
Yeah.
And that's the biggest aspect I don't like.
Yeah. Ask a permission to leave. Yeah. I feel you on that one. I'm out in Guam right now. I definitely don't live in Guam. Yeah. Well, speaking of your family, I noticed one of your most recent Facebook posts was you had your daughter be in your filmographer for walking through your 123 unit. So I'm guessing that you probably take pride in bringing your kids around, kind of showing them what it is you're doing. Do you guys have a household where you don't talk about money at the table, or do you have a household where money's talked about at the table?
I'm drilling money to their head all the time. I think they're sick of it.
Yeah.
Uh, because I'm on this kick of, eh, don't build other people's dreams. We can't do it like our parents did it, and so I'm constantly, beating that into their head. You don't have to work for someone else if you don't want to. I want to be the last generation to make that choice, right? I'm going to get out, but I look at it as getting out, right? Getting out from the W-2.
Yeah.
But for them, I mean, it's an option. If they have their dad who's doing it and they want to start a business or be able to buy real estate, I mean, I can help them with that. So what I do is for the apartments, I bring one at a time.
Yeah.
They come one at a time with me, and then I just talk to them. I mean, my twins are, I don't know what I'm really going to tell them, right? But I got a 17-year-old where I can do a little bit higher level, and
Yeah.
you know, 8 and 7-year-old. So
Yeah. I bring them both. It just turns into a play fest.
right.
You get anything out of them. Yeah, I hear you. That's so me and I didn't start out in real estate. I started out me and my brother, we run baseball tournaments throughout Louisiana to Florida, all the way up to Kentucky. But I was running baseball tournaments, and we, make money off the concession stand. So I'd bring my daughter. She was like five, 5 to 7. And man, I taught her a little bit of branding. She went and got she picked her name. Her name was Gumball Kylie, and she had
Nice.
a airbrush shirt, Gumball Kylie. She had the whole outfit, little pink hat, little bubble gum hat, and she'd roll around with a fanny pack and a bucket of bubble gum. And she was like, "I want to sell these one at a time." I says, "Well, hey, how about this? How about how much you want to sell each one for?" She says, 25 cents. I says, "Okay. Well, why don't we put 10 in a bag and you sell it for $2? How about that?" And she goes, "Well, who's going to buy 10 pieces of gum?" I said, "Girl, you're going to see who's going to buy 10 pieces of gum." And she would go out, instead of selling one little piece of gum, she would sell a bag of 10. People would tip. People pay her $5 for a bag of gum. She would make 80, $90 in a day as a 5-year-old. Right.
Wow.
I mean, she thought that was going to last forever. Now she's 12. Ain't nobody cares. You ain't cute. You ain't Gumball Kylie. You're Kylie making money. So that wore off, but she loved it. I mean, it was fun to see my kid out there hustling, you know what I mean, and having a good time. But I think that's important. I grew up, at the table, you didn't talk about religion, you didn't talk about politics, you didn't talk about money. It seems like those are the only topics that get talked about anymore. But definitely in my house, I like talking about money, and I think it's important that your kids kind of that you don't hide it from them, because once they get older, that it's been hidden, and now the only thing it's going to teach them is college, which everybody who's in college is all about the W-2, go get your job, work for the man. So yeah, I'm glad you said that. Well, cool. So let me ask you this: what's been your biggest failure or your biggest mistake in real estate?
Biggest failure. Let's see. I could talk about the time I almost lost my brother-in-law's money, or I can talk about the time that I was going to build a residential assisted living, 3 houses, but I lost that deal because I couldn't raise money.
Let's
Let's
talk
talk
about the
about,
the brother-in-law.
okay. So my brother-in-law, my wife's brother, He's like, Trent, you doing real estate? I'll do, so he was giving me the money to put down on the flips or the new builds. So I'd go buy a lot, or I get a construction loan and I would have to put down 10 or 15% of the whole deal. So if the house cost 200,000 and the lot was 100,000, so we'd have to put 30 down. Long story short, I bought this big house for like 300,000 in the Irish Channel in New Orleans, which is, it's kind of like off St. Charles. It's becoming really affluent, right? And we were going to put, I don't know, $250,000 into it. Well, they have this, it's a historic district, right? So I'm like, okay, so like I'm underwriting everything, and I usually underwrite, okay, 6 months to do the renovation, 6 months to sell, and then that's a whole year, and I'm usually pretty good. I mean, it's usually pretty good, underwriting. So I did that. We bought the place, and then back of the house, it's called a camelback. So it would kind of go like this, and then it was like this back portion.
Okay.
Well, the historic, we needed to tear that down to do what we were going to do. We already had architectural plans, everything. And the historic district found out that it was original to the house, which meant we couldn't tear it down. So then that took months. So we had to get a structural engineer to determine that, we had to tear that portion down. And once you tear it down, then there's nothing historic to save. But it was just taking too long. And I was, I mean, the bills were piling up. And so we could have made a bunch of money if I went to the end, but the investors are always more important, right? And so,
Yeah.
I just pulled the plug and I wholesaled it to someone else. We still made a little bit of money, but it was getting kind of dicey there for a
Yeah.
while, because it was a bigger property, and so there's only so many investors that'll, buy for, those more expensive properties. But another investor came in and partnered with my contractor buddy, and he still stayed on the deal. Somebody else came in, and I think they were all in like 600 something thousand, and I think they sold it for like over $1 million. So I mean, they still made a bunch of money, but I mean, for me, it was more important to get my brother-in-law's money back.
Yeah. Get that Thanksgiving dinner.
So I think the mistake in there was not so much of a well, I guess a mistake is just going into an area where dealing with a historic district, not dealing with the historic district before, and just not being educated enough on that part, and it kind of went awry on me. So
Yeah, I hear you. Well, cool. So the question that I ask everybody to kind of wrap up the show is one I didn't prep you with this question, which I normally
you
do.
did.
So I apologize. So I'll give you a second to think. But the question is, what really bruises your bananas about real estate? What I mean about that is, what's the biggest lie being told in the real estate world? No matter what it is, any flavor, your choice. But what's the bad gouge being put out about real estate?
The bad gouge being put out.
I knew I should have prepped you. Damn it.
You should have prepped me.
I should have prepped you. Yeah.
I'm Master Chief for you, man.
Come on. Come on, man.
So on the multifamily side, not the bad gouge, but you ever see just closing these I think the bad gouge is that the rent's going to continue to go up.
Yeah.
Like, hey, if you go into Austin, or if you go into because Austin's really hot, or you go into Phoenix, the rent, you're going to get that annual 3%, right? Oh, annual 3%, annual 3%. You can underwrite to 3%. And I think that's bad advice.
Yeah.
I really think I think people should be focusing more on what you can do with the property. Does the property work without that kind of cost of living increase, or the increase in rent in the market?
Yeah.
I
Are you
think
reliant
that's
on the market giving you gifts, right? It's pretty much.
relying on the market giving you gifts. That should be the cream on the top.
Yeah.
It should work. It should work without that, or like just 1% on there, because everything's going to go up like 0.5%, 1%, inflation a year. But I think that's bad. That's what I would think, to underwrite to that 3% to make deals work.
Yeah. And what you talk about is not the rent going up after renovations have been made, right? And I'll explain, because I know exactly what you're talking about. You see kind of on that waterfall structure, on the underwriting, like, yeah, it's going to go up 3% automatically. Well, that's
Right.
not, you don't know that, right? You're assuming that, and that is an assumption, and we're allowed to make assumptions. You just have to make sure that your assumptions are at a minimum realistic. Conservative is better, but sometimes being so conservative means opportunities just fly right by you without you being able
True.
to take action. But realistic, right? And it's got to be based on historical data, which a lot of times it is, but there's also a 2008 in history, right? there's also a
Right.
COVID in history. There's a lot of things that come up. But if somebody is showing you a deal and it says, yeah, the market can bear an extra $100 in rent if the units are renovated, and they show you comparables, 3 or 4 different
Backsplash.
Yeah. The back, you add that backsplash, get $200 rent pop. But if you can see, if you're an investor and you can see on that pitch deck, all right, there's 3 other apartment units right down the street in the same neighborhood that have better appliances. They have, they're just a little bit nicer. Maybe the flooring's easier to clean, and they're all getting $200 more a month in rent. Well, then that justifies that rental increase, but that rental increase takes time and effort, right? It takes renovating the property. What we're talking about is if all 4 of those apartment complexes are getting the same rent and they're the same look, and you're just assuming that rents are all going to go up, all ships rise with the tide. That is true, but the tide better be coming in, right? So that's
right.
that's what I like to call the market giving you gifts. It's a appreciation over time, market rental growth, cap rate compression. All of those things are something that a syndicator has absolutely no control over. That forced appreciation is what we do have control over,
Right.
and underwriting for cash flow, we have control over that too. But as is, it's like the property as is will cash flow. But anyways, well, cool, man. Trent,
Yeah,
let's wrap this up with asking, how can people get a hold to you? Where can they learn more about you, and what's the best avenue to reach out to you?
I'm on Facebook. I'm on LinkedIn. I have a Facebook group, Multifamily Wealth Factor. If people want to join that, trying to grow a community there, just to kind of help limited partners, help general partners, just kind of build a community there. But yeah, my email's Trent@TLBstrategic.com. Always looking to talk multifamily, looking for partners, looking for co-GP, and looking for investors, and
You only invest in Louisiana, or are you looking at other markets?
no, I'm looking at other markets. Definitely
Okay.
looking at other markets. I'm willing to go where the cash flow is, as long as the population is, try and stay, I don't know, maybe an hour and a half outside of a bigger city kind of helps too. 100,000 people or more, but yeah, if you can, put a team together, and it's, even a flight away, right? If you don't have boots on ground there, and it's not like a heavy lift, as long as there's not a connecting flight, as long as you can fly direct, it's pretty good.
Don't give me no layovers, man.
Right.
Yeah.
Give me
Well,
no
all right, Trent.
layovers.
It's been great, man. I appreciate you coming on to the show. I hope you consider me part of your network now, and let's connect in the future.
Definitely. Thanks for having me. I appreciate it.
Yeah.
Thanks for listening to the Gorilla Estate Investing Podcast, where we give you the ground-pounding truth about what it takes to be successful in real estate. Learn more at realfocus.org/Gorilla Estate Pod.